Conversations. I'm Neeraj Shah, and it pays to talk to people in multiple facets of the risk asset space and the capital market space to try and understand what is the impact of this whole global uh, global developments that have happened on risk assets by and large. And to do precisely that, we have with us today Anshu Kapoor, President and Head of Nuvama Asset Management. The idea would be to try and talk about, of course, as I said, the global market impact or the global jitters impact on the listed space, yes, by and large, but they are also fairly large on the private space, and it'll be great to get or pick Anshu's brains on that aspect as well. Anshu, great having you. Thanks for joining in. Hope all is well.
Yes, Neeraj, all is well. Thank you for having me. Good to be with you.
Now, the pleasure is ours, Anshu, and I'm particularly interested in knowing the second half of the conversation as well. But let me just start off with what you are thinking through. What is it that you're picking up via your conversations within colleagues and outside clients about what this SVB come Credit Suisse crisis, if you will, does to the overall landscape?
Right. Yeah, as you can see, and we've been witnessing all of this, Neeraj. A lot has happened over the last 10 days. And again, there are fears of going back to the financial crisis and so on. But what it seems like today is that this is more of a duration crisis and not a credit crisis. So therefore, all these issues around defaults, corporate defaults, bankruptcies, they seem a little far-fetched as of now. Largely, this is led by markets not being able to absorb the level of interest rates, and which have gone up, I think, in the last 40, 50 years. The rate of increase of interest rates has been the highest. And I think there's a generation that's grown up not knowing what it looks like or seems like or feels like to be in higher interest rate environment. But at the same time, I must also say that nothing is isolated. Therefore, given the interlinkages, it is important that some of these issues are addressed quite proactively, which is what we are witnessing. And what could be a classic run on a bank can become a bankruptcy or a liquidity or a corporate problem as well. So far we are away from that, but I hope that this kind of doesn't degenerate into a bigger problem that we can solve.
So since that remains in the realms of imponderables, now let's try and think of what is it that is easy to be, or relatively easier to be predicted or thought about and thought through, and that is what is the likely impact back home. Now again, a lot can change if developments change out there, but ceteris paribus, if this is contained at the current juncture, Anshu, what is the impact on liquidity, on transmission, what have you?
Yeah, I think fair point. There are three forces that will determine how India gets impacted. And Neeraj, the first one is playing out already in front of our eyes, that is trade. And as we can see, merchandise trade volumes are slowly beginning to go down. The global trade volume that had picked up after the COVID crisis is abating. And that was led by easy money and consumer demand, revenge shopping, and so on. But as of now, given that China is still out of play, Europe, US are slowing down. So consumption, which is a big driver of Indian merchandise trade, global consumption is slowing down. And we are beginning to see that in the data. It will also start to impact, and it is actually, it's already in the price of all the IT services stocks as we speak. So there is a fair amount of uncertainty on the IT services exports as well, as to how the demand scenario will be projected from here. And therefore, exports put together are projected to be about $750 billion. It's a fair, large chunk of our India's GDP. And any slowdown there does impact job creation here, does impact corporate profitability. And therefore, we need to look at as to how this resolves. Just to give you a data point, after the COVID crisis, the new job creation by IT services alone created income growth of about 1.4 trillion rupees per annum. So it's a very meaningful contribution to the overall income creation. And any slowdown there hurts. And a lot of merchandise exports are what you call blue skill job creators. And therefore, at the bottom of the pyramid also, the income creation effect is felt. So I'm just making a point that trade is something to watch out for. The second transmission point is price. And we've been price takers of commodities largely. We are price takers of crude in a big way. I believe whatever is happening globally, I think we will benefit from the price pressures on overall commodities. Like we just discussed, that slowdown will maybe depress the prices of a lot of these commodities that we import, and therefore we could be in a better position. But price has also 2 points, two facets, if I may say. We've been growing very well on a nominal basis.
Mm-hmm.
Inflation has been high, 7-8%, and then real GDP growth is about 6-7%. So that's a great nominal growth, which does inflate your tax collections. We've had a great couple of years in from a tax collection perspective, GST, income tax, and so on. So that does impact tax collections. Any slowdown in inflation will maybe slow down credit growth as well. The moment interest rates go up, there is an increase in demand for working capital and credit. Anyways, credit. So it is not linked to the capex cycle per se, but there is a nominal inflation that happens in the economy, and therefore, if price pressures go down, inflation certainly cools off. I think the problem is jerks in all these data points. Economy and markets very well adjust to a gradual increase or decrease. The problem happens suddenly there's a drop, or suddenly there is a increase in any of these things. So therefore, I think the second point I made was the price. So that is to be washed out. And third is liquidity, Neeraj. We are capital account deficit country, given that exports are always greater than imports are always greater than exports on the merchandise side. And therefore, it is pertinent to watch our BOP data. There is anyways a slowdown from last year on private equity, FDI, and so on. And any liquidity crunch, suddenly freezing of liquidity, what tends to happen is liquidity suddenly freezes, and we've seen it over the last 15 years. If suddenly the liquidity goes away, then markets or economies which are capital account deficit, first impact is on the currency, and then the currency leads to price inflation, imported inflation. It leads to all kind of problems for the central bank. We've been fortunate actually that we have not seen a repeat of 2012-13, but I think this is something for RBI to watch out for, the liquidity as well. So there are these big factors, and nothing is a given as to which way it will go.
But is the base case, for example, that IT services take case in point? Base case would be that their numbers would slow down, because if BFSI in the West is undergoing such a challenging period, very difficult for them to give out guidance on the kind of ordering that they will do to the IT companies, and therefore very difficult for Indian IT companies to give a meaningfully correct guidance, considering BFSI is such a large portion of their overall book.
Yeah, absolutely. And if you go back on the commentary or the narrative by global IT services firms and Indian IT services firm, we started, let's say, 2022 by everyone saying there's no problem at all. And by the last quarter, calendar year last quarter, most IT services management teams were saying, okay, we are being cautious, we are watching out. So I think that is how it's playing. Whenever there is a crunch, the first things that stop for a corporate is any kind of discretionary spend, like it does for a consumer.
Sure.
And if there's any discretionary kind of a spend on IT services, it will come into question. So we have to see as to how this kind of evolves from here. Neeraj.
Got it. Now the private markets, Anshu, and would love to understand what's the impact thereof that you see, because multiple calls on day one of their Silicon Valley Bank issue, that it's a Lehman moment for private markets or startups in particular. What's your sense now that some water has passed on the bridge?
Right. I'll make 2 points, Neeraj. Number one, I think this notion that there is a funding winter is not correct. I would like to dispel that notion. Just even look at the data points, at least until last quarter. Okay, so from 2000, maybe 18 onwards, until last year, average, FDI or private equity investments in this country would be about 50 odd billion dollars, 40, anywhere between 45 to 50 billion dollars. We had an aberration in 2021 where we got 75 billion dollars. Okay, last year we got 55 billion dollars, which is higher than the trend line, right? So as of now, until now, there is this notion that okay, suddenly everything is dried up, is not correct. The second fact is that there is definitely a slowdown from a internet economy, new economy, startup funding perspective, right? So the venture capital investing or investing in a lot of these D2C and other companies that we were seeing, that has definitely slowed down. But there is a dramatic increase in real assets investing. And what do I mean by real assets? It's real estate, warehousing, logistics, data centers, infrastructure. So that segment is up about 60% year on year, whereas the VC segment could be down 40-50% year on year. So you can see there is, let's say, a pivot in the investor preference from a sector perspective. So that's a big trend we are witnessing right now. Overall, yes, it has gone down by about 20 odd billion last year. This year, we anyways need to see. So these are two big points, and then we can talk about individual themes within the private equity and or the private markets.
Yeah, actually, I was gonna come to that because a lot of people making a beeline for the new economy, the sunrise themes. There has been a bit of a pushback there, maybe towards certainty. So, would love to know under the current picture as well, where is it that you believe incremental capital could flow in the private side?
Yeah, that's a good question. Thank you for asking that, Neeraj. I guess what's happening is that one, the larger companies or companies that are anyways where the revenue models are proven, business models are proven, those companies still have an advantage to raise capital. Two, I think the excesses are behind us, and therefore it is taking longer for any company to close an equity round. Valuations are, I believe, now finally coming in line. So, whatever excesses we had on the valuations, slowly, that seems to be coming off. Growth at all costs. I mean, that was the kind of narrative in a zero interest rate environment, right? So that seems to be off for now, and there is obviously, as we keep reading, demand on profitability. And that's a very real thing. I think it's a very good thing qualitatively. And therefore, the larger companies could benefit within the startup space. I think founders will have to work harder. If you're a VC or an angel kind of an investee company, you'll have to work harder as of now. I think the promising side is that new avenues are also coming on the capital structure, which is, let's say, something like a venture debt fund. So there's several venture debt funds out there which are going out to these corporates or these startups and saying, why don't you also supplement your capital structure with some debt? Can we help you with an alternative source of funding? So don't just use equity on the capital structure, but maybe you can use some other avenues. So that is from a investee company point of view. But I think there's a big trend playing out on the global allocators point of view.
Mm-hmm.
So if you look at, there are three core geographies that allocate capital to India, and first of all is obviously US, North America, US and Canada. Second is Europe. Third is Middle East. Asia has been still small as far as the FDI contribution to India is concerned. What we are seeing is Europe and US, the mood is a little cautious and borderline somber as well, depending on which geography that you talk to. What has happened out there, Neeraj, is that their Asia allocations have been, let's say, above 50% allocated to China. And there, obviously, the experience has not been great over the last 4 or 5 years. And also, there are, let's say, certainly the allocations on the overall portfolios went up and public markets also corrected. So now, private markets allocation to global portfolios is looking very, very large, right? So overall, if they were, let's say, 9 to 10%, allocations could have gone anywhere between 16 to 20%. And these are all illiquid assets.
Yeah.
So there's a pause from a global allocator's point of view that, listen, let's pause, reassess our portfolios, reassess our positions, where can we draw liquidity, where should we invest, and then take a view. So all these pointers have nothing to do with India, but the global allocators, let's say, perspective or positioning. The only allocator from a global perspective who is still allocating to India is Middle East investors. And you've been reading the news flow, a lot of sovereigns and other funds have been very active. So they filled in some of the space, but overall, there is definitely a lesser number available to India as of now.
Okay, but relatively better off than maybe some of the other geographies.
Oh, yes, absolutely.
Okay. And would it,
Yeah,
sorry, I'm just wondering, and at least my final question, would it take, Anshu, the catalyst of better public markets to get the private markets rolling again? Or now that the alternates and the private markets are so large, that you think that they could move independent of what is happening to public markets?
Unfortunately, nothing is independent, Neeraj, as we have all realized. And yeah, you're right. There are all these interlinkages out there. Like I said, if your overall portfolio shrinks by 15-20%,
that's true.
The problem that has happened is that a lot of portfolios are in bonds as well, right? And maybe I'll just maybe kind of segue into the HNI market as well. Globally, a lot of these portfolios are levered. And those portfolios on bonds, which were supposed to be your safety investment, those portfolios are down about 20% globally. And if you had a lot of leverage, then you lost a lot of capital as well. So your safety investment has lost capital, your risk assets are down, and then alternatives, suddenly everyone is realizing that are illiquid. So, and not to name the fact that in crypto, a lot of institutions or funds had also come in.
That's true.
And so did the private banking markets, all the ultra HNIs and the family offices. So if you're losing capital overall on your portfolio, the first reaction is to preserve. And I think this may not appear kind of very close to us because I think the mood in India is a little different. But globally, that is what is happening. So people are shifting from growth to maybe safety, preservation, liquidity. And I think once they are comfortable with all of that, they could maybe look at allocating more capital. So it will take time to, in my opinion, to play out. But at the same time, a lot of Indian capital is now opening up to alternatives. And maybe if we can spend a minute on that, I can maybe
Sure, we have about a minute left. So yes, would love to hear that before we wrap up.
Yeah, so Neeraj, what's happening in India is Indians are saving about $750 billion a year. Okay, so it's a staggering number for any economy. So that $750 billion used to, earlier go into largely 50% used to go into real estate and gold. And the remaining half, a big chunk would go into small savings, bank deposits, then followed by everything else. But what is happening is that at least there is a generational shift. One, in looking for growth assets. And two, as far as I can see, overall across India, there is a huge interest in alternatives. Why should an Indian customer or investor not have access to private equity, real estate, infra? And this trend, to our surprise, is catching up very fast. Just to share again data point, 30% of our new investors by count are coming from cities beyond the top 10 cities of India, which it's surprising for me as well. I didn't anticipate, this kind of demand could come. So I think here the problem is of supply, good quality products and investment solutions versus demand. So a little bit of gap will be filled by Indian capital is what I feel.
That's music to the ears. They've filled up the gap on the public markets for sure by the SIPs.
Yeah.
Let's see how it moves on this piece. But
Yeah.
Anshu, great to get that picture. Thank you so much. It's not something that we do very often, which is talk about a private market. So lovely to do that today in such times. Thank you for taking the time and talking to us.
Thank you, Niraj.
Yep. And viewers, thanks for tuning into this conversation.